Alrighty guys, so we're going to be going over how to manage a trade and how to not get scared when to enter a trade or hesitate. So I think this is a huge reasons why traders can't execute trades because they have potentially a profitable strategy and a profitable mindset to trading to become profitable, but they are just emotional on the execution part of trading. So today we are going to go over how to manage your trade, how to scale, how to take partials, where to put your stop loss, all those things to make it where you are an emotionless trader going into entries. Alright, so now we are going to have a checklist on these three things. First, you should check if you have a change in the state of delivery. And the second thing you should have is a fair value gap, or you inverse the fair value gap in a SMT. If you have these three things checked off, that is your trigger to enter, and you should have no emotion entering because this is your model and you know your model is profitable, so there should be no reason to be scared to enter this trade. You may be asking, where do I enter the trade? This question should be simple. You should be basing your entry off of your model. For example, if you see an untouched fair value gap in the 1 minute and you want to see price move down before you potentially see a move higher, or if price inverses it, then you would not enter the trade. You should react to the market, not try to predict what the market is doing. A second reason is you could see a change of the state, and we potentially recently inversed the fair value gap, so you could enter off of that trade, change in the state, not a potentially fair value gap that we didn't have. So it would be more of a quick reaction entry, and you would have to be emotionless through that because you do have confidence in your strategy, and you should have confidence in your strategy. A lot of people put their stop loss for a 1-to-1 RR. This model, you cannot do that. You should not be putting your stop loss on these random numbers because price could want to go down there, and you should put your stop loss on a price or a point where if it does go to that, your trade is invalidated, and you should probably re-come to the market and get a different market, like a view from it, because your trade was not the entry. A lot of people get this confused because I'm going to go for a 1-to-1 RR, but maybe that 1-to-1 RR, your stop loss, is not at a point where price is going to invalidate that. So you may have the right bias, but if you put it in a random spot in the market, it could tap down and then run up to your TP. So your price, your stop loss should be at a point in the market where it would invalidate your entry and your trade. So places where you could put your stop losses are at change of the states. Like after we completely take a high, you should probably put your stop loss down at that change of the state. Maybe we don't want to see a retest down there, or a fair value gap that we just tapped into, and now price is moving back higher, and we do not want to see price go back down there to potentially inverse that fair value gap. So there's many different ways. If you have a $300 stop loss, I mean, you move it up to a $15 stop loss just to feel good about yourself. Like, I'm only risking $15 on this trade. You may manage to win the trade, but you're gonna get stopped out before you can even have a chance of taking a trade because you're so scared about losing that $300. You have to, once you enter that trade, you have to be fine with losing that money immediately and not be attached to it, because that is what could potentially happen, losing the trade. So do not be fidgety with your stop loss. Leave it there, trust your model, and just let the market do its thing. Alrighty guys, so we are now looking at the market, and I'm going to show you a way you can control your stop loss. So with this, we just took this sell side right here. Here's our external buy side and our internal buy side, right as in here. So this is what I would do. So we get a clear move above the change in the state of delivery. We have no fair value gap. We do have this breaker block right here that potentially we would want to see inverse, which it does get inversed right here. I would take my trade above this change in the state right here, put my stop at this breaker block, put my stop at this external high right here, lining up with it, and where I would move my stop loss. Okay, so I have my stop loss set here because this would invalidate it, but then we have this internal high, and I would not want to see price take this internal high and then come back all the way down. So once we tap back into this internal high, I would move my stop to break even. This is what I would do, my stop to break even, because I would want to see price take internal high, then while taking internal high, take external high, because I would not want to see price just take this internal, sell off. So this is why I would move my stop immediately to break even after we take this internal high, because I'm managing risk well, and it gives me a reason for, if this trade did flip, it would invalidate my trade and I would be risk free on the trade, not risking $300 on this trade and losing it. This is just being smart in the market and taking what you get. Alrighty, now we're going to go over scaling your position and how you would do that. So we just took this buy side level right here. We did retest this breaker block right here. We retested, we moved up, did not take the internal high or this recent high that we have. So I would want to see price enter here. We do have this fair value gap that we did make. This would give me more confidence. We tap back into it, go into the 30-second. We do see price tap back into this fair value gap, have our 30-second change in the state right here. Take my trade, shorts right here. Put my stop at this top of the fair value gap because this would invalidate it. I could put it at this recent high, which would be smart, but I would, if you're wanting to put more onto the trade, I would put it at this top of this fair value gap. Target this internal low right here, relative equal lows, right there, and potentially you would take partials at this internal low, or this would be the smartest. You take partials right when you take external low. So say you have multiple contracts on, you let price run, we create a fair value gap right here. You have partials, you have like one contract left, reaches back, you can scale into it right here because you want to see price move lower. If you have used standard deviation, you could target standard deviation levels or equilibrium. This is where you could potentially scale, put on more size, and then just let your runners go as we dumped. So that is how you would scale into a position, take partials. The only reason you would hold is if you have higher time frame alignment, and which would be standard deviation, or you want to maybe see price move back to equilibrium of the range. That would be reasons of holding trades and not targeting sell side liquidity. Maybe you want to see price move back to some key point in price. So definitely high time frame alignments do help in trading. So your goal in trading shouldn't be I should make $1,000 a day. Your goal in trading should be I should take clean trades with zero emotions, because building good habits is the profit side in trading. So you'd pick your dollar amount. Maybe you want to risk 250, 350, 450, 500, whatever it is. You would set it to that. So if you did have a terrible entry, which if you did, you shouldn't even enter in the first place. Like maybe, oh shoot, maybe you enter here, but your stop loss is going to be this high, and you're going to target runners down here. You should not be risking the same contracts, because if you're risking 500, if this is your $500 trade, that's like 4 contracts, and you're putting on 4 contracts, and this is like $1,000. You should not be risking that. You should be able to manage your risk on each trade. Each trade is going to be different, but if you risk the same amount of dollars, that is going to save you in the long run, because if you only risk 250 and make 500 out of it, that's a win. You don't need these $1,000 days, because if you do lose the trade, it's going to end up kicking you in the butt, and you're not going to be, that's not a place you want to be at. The times you should not be entering the trade is when you find no SMTs or setups not even there. Maybe you're like, oh, we just tapped into this fair value gap, price is looking like it's bearish, I want to see price go down here, and you enter and you bang out $1,000, you didn't make any money. This is the market's money, and it's going to take it all back at some point, and you just built terrible habits, and you won't be profitable long. Maybe you'll make a little bit of money, but you're soon gonna be struggling. So do not trade your model. Do not be excited because you think you see a good entry or you know they draw on liquidity but you don't see your model. Trade your model, trust your model, and that is what will build good habits and profitability. Reasons your risk management could be cooked or get or hard to manage risk would be having FOMO. FOMO is a huge thing in the trading community, or being overconfident in a trade, like, oh, this trade looks perfect. I'm gonna put on more sides instead of risking 500. I'm gonna risk 1,000, and that 1,000 could be the 1,000 to blow your account. And you're like, this trade is going to work, and it ends up not working. Then you're in a bad spot, and you are going to be mentally not right in the right spot. So stick to your risk and don't enter FOMO. Don't be overconfident. Don't over ego yourself, and just be on the floor. Just be grounded. Have your feet on the floor. Alrighty, guys. So that is the end of how to manage your trade. Your homework for this video is go back on the last 3 trades you took. See if you saw a valid for value gap. See if you had a SMT. See if you had a change in the state. If you didn't have those 3, maybe it was not so good of a trade, and maybe you won it, maybe you lost it. If you lost it, there's something to learn. If you won, there's still something to learn. As an experienced trader, you learn new things every day. The market provides new things every day for you to learn as a trader. You'll never be not learning something in the market. So just look back on your trading recaps and see if you had those things. Maybe go in your journal and write the things you need to manage your trades, how you're going to manage your trades. Don't be a FOMO. Write these down and you'll become an actual machine, and you'll be doing the things other people don't want to do, because journaling is not fun. It's boring, but it's the reason why people aren't profitable, because it isn't fun. It isn't looking at the charts, seeing your P&L go up. Journaling isn't fun, but you should do it, and that is what will help you. Alrighty, guys, that was episode 6 of the trading series. So you just learned how to trade the forever model, and not just how to trade it, but you can see it now. You can actually base your trades off entries. The next episode we are going to be going over is journaling, and how journaling is the reason people become profitable and don't have that need that extra step in trading, and now they have it because of journaling. So without further ado, guys, I hope to see you all in episode 7, because journaling is a huge step in this model and trading as a whole. So I hope to see you guys in episode 7, and peace out, guys.